Okay, good day, everyone. Welcome to another edition of Strategic Financial Management. In today's class, we shall look at one of the past questions under the merger and acquisition. Right then, class, this question is one part of merger and acquisition. Don't forget, merger and acquisition is also a method of valuation of a business. When you want to merge or acquire or you want to take over another business, you have to do valuation of a business, right? Now, this question is one part of merger and acquisition. The other part of merger and acquisition is I don't want to go into okay, the second part is share to share exchange, share for share, share for share, right? Share for share exchange, right? That is in acquisition. Don't forget, one of the disadvantage of acquisition is what we call loss of proportionate in ownership. There will be a dilution of shares when there is merger. There will be a dilution of shares. So another part, one part is free cash flow. Normally we do the normal free cash flow to equity. The second part is when the company wants to use share for share exchange. And then the question will now be, if I want to combine this company, what would be will there be an increase in the value or decrease in the value? Right? We'll get there. So we have already, in our last class, we've analyzed this question. That the question says that estimate how much synergy is expected. This question is adopted from Ican Pathfinder, right? May 2019. Estimated how much synergy is expected to be created from the takeover using free cash flow to the firm analysis for each individual company, and the potential combined company. Now, the question is, what is the synergy that arises as a result of these two companies? Then we need to prepare a free cash flow. Don't forget, what is synergy? Synergy is the profit you make from a combined company instead of instead of separate, right? That is the synergy. Now, we need to calculate the free cash flow for each of the individual of the firm. Then we will now do what? We will now do the combine class. We will now do the what? The combine. So this is the question. We've analyzed it. For those who actually go back to the introduction, right? Now, if we are to determine free cash flow to the firm, don't forget, when we are to determine free cash flow to the firm, what are the ingredients we need, right? Now, let me come again quickly. Paco PLC will soon announce a takeover bid for Ronke Tina, a company in the same industry. The initial bid will be an all share bid. The initial bid was on all share bid of 4 Paco shares for every RTPLC, which means that if the initial plan is that for every 4 of the acquiring company will issue 4 4 4 from the what acquiring company, or for every 5 shares in what in out. So for every 5 shares, let's say you have 10 shares, 10,000 shares. So for every 5 of these 10,000 shares, right, Paco will give we issue 4 4 4 4, right? We'll get to shares, right? Now, share for share. The most recent annual data is given. We have dividends, other information, annual replacement. Don't forget, when you want to calculate, do your free cash flow to the firm, it is your profit after tax, add back non-cash item, right? Then we have the increase in working capital, if any, if there is increase in working capital or decrease, the replacement, right? Then what do we have? Non-current assets, increase in non-current assets. Then we can have our free cash flow, right? To the firm. And we use what? The weighted average cost of capital to discount because it is free cash flow to the firm. Now, annual replacement capital expenditure, right? The annual replacement capital expenditure, look at the cost, can you see it? Now, what will be the growth rate? Expected annual growth rate in sales. Sales will increase. Operating costs, including depreciation, replacement investment, and dividend for the next 4 years, which means that all these items listed will increase in the next 4 years. So when you are doing your free cash flow, class, when you are doing your free cash flow to the firm, you have to increase it for 4 years. It has to be 4 years, right? It has to be what? For 4 years. So you can just say year one, year two, and year one, year two, year three, and year four. You increase your annual replacement. Don't forget, replacement investment will increase for the net, including the dividend, will increase for the next 4 years, right? Which means you have to grow it. Year one, increase by 5%, year two increase by 5%, year three increase by 5%, year four increase by 5%. Now, another one, expected annual growth rate in sales, operating costs, including depreciation, replacement investment, and dividend after 4 years. Class, this is infinity. 4 years after. You can see the first one is next 4 years, right? Year one, year two. The second one is after 4 years. That is beyond, class, beyond, right? Beyond 4 years, right? Which means we have to do our what? The usual infinity. Now, the next one is the gearing ratio is 30, right? 55. The market price is given. The numbers of share issue is given. The fixed cost, the interest cost before the tax is given. Then equity beta is given as well. The risk-free and the market return. Now, lastly, the takeover is expected, class. The takeover is expected to result in cost savings. Don't forget, one of the advantages of merger or acquisition is because of what? Cost savings. You want to reduce costs in advertising and distribution, reducing the operating cost, including the depreciation of PACO from 76%, class, from 76% to what? 70%, which means that if they take over, right? If they succeed in taking over that company, the administrative expenses will decrease to 70%. It means that when you want to determine the administrative and distribution, as well as reducing the operating cost will also reduce to 70%. 70% of the sales. It will be 70% of the what? Of the sales. Now, the growth rate of the combined company is expected to be 6% per year for 4 years, right? For 4 years. For 4 years, which means that when we need to determine the combined company, don't forget, the combined company is the combination of both the acquiring company and the acquired company. When you combine them, what is the synergy, right? We'll calculate synergy, right? Don't forget, if the profit of PACO is 10 naira, the profit of RT is 10 naira. When you are combining them, it means you are adding maybe the sales together. Is that not so? You are adding the sales together. That is combined, right? That is combined. And 5% thereafter. So definitely there will be what? There will be beyond as well. RT debt obligation will be taken over by PACO. The corporate tax is expected to remain 30. Sales and costs relevant to the decision may assume to be in cash terms. Assume to be in what? In cash terms. So quickly, suggested solution. Oh, the PDF. I have to share all my coming to share all my screen, the entire screen. Okay. Coming, I need to share my screen. So first, suggested solution. Please confirm if you can see my Word document. Word, confirm. Unmute your mic. God, I can't see you. Just unmute your mic.
Yeah.
Yes, sir.
Okay, that's fine. Okay. So since we are to calculate the free cash flow, right, for each of the firm, for each individual company, and they combined. Can you see it? And they combined. And the what? And they combined class. Right? The free cash flow. The first thing is that what you will use to discount the free cash flow, it is weighted average cost of capital. First, determine your weighted average cost of capital that you will use to discount. Let's start from PAC, right? So please, presentation matters a lot, please. PACO, right? Okay. So weighted average cost of capital is equals to weighted average cost of capital is equals to, what is our formula? VE times cost of equity divided by plus value of debt times cost of debt if it is pre-tax. I can use hash total, tax rates, right? So this is divided by value of equity plus value of debt. Value of equity, value of equity plus value of debt. Same thing applicable here, value of equity plus value of debt. Class. So if this is established, right?
So
If this is
sorry, cost of equity.
what is cost of equity? I don't understand.
Oh, so like the first one. Okay. Oh, sorry. You interchanged it. That's why I didn't see it.
Okay. There's no specific format. There is no specific way that you must present how to determine your weighted average cost of capital. Present it. Weighted average cost of capital, if you like, change it upside down. You still have weighted average cost of capital, right? So there's nothing. So now, the first thing, let's determine our cost of equity. Don't forget in the question, right? In the question, market return is given. In the question, market return is given. Risk-free is also given as well, right? Market return, risk-free, and equity beta. The first one is PACO, is the acquiring company. ACT, the second company, is the acquired company, right? Is the what? Acquired company. Equity beta, risk-free. Please take note of this equity beta, 1.18, risk-free, and market return, right? Risk-free and what? And market what? And market return. So equals to risk-free, risk-free plus equity beta, market return minus risk-free. Cost of equity is equals to what is the risk-free given in the question?
4%.
Plus 1.18, which is the equity beta. You can confirm that. What is the market return?
11. 11%.
11 minus 4, right? So what is cost of equity? What is cost of equity?
12.3.
12.26.
12.3%.
12.26.
Okay,
6.
12.26%.
Yes.
Now, if this is established, what will be our value of equity in the question? Now, let's check what will be our value of equity. What will be our value of equity, right? Don't forget, we were given all this, right? The gearing by market value. Is that not so? So you can see that the level of gearing is debt divided by debt plus equity. Is that not so? Now, I have two ways that you can use. There are two ways you can use to get that, to get a value of equity, right? So let's say we bring out the gearing is equals to debt divided by debt plus equity, right? Equals to debt divided by debt plus equity equals to how many percent given to us? Equals to 30%.
30%.
30%. So this shows that the value of equity, is 70, while the value of debt is equals to 30. Class. So this shows that the value of equity is 70, because if you put 30 here, this place 30, then the balance is what? Is 70. You can now put it here. The denominator will become what? 100. So the value of equity is 70, while the value of debt, let me say this 30 plus 70. Okay. All right. Now, what is the cost of debt? The cost of debt. Let's quickly go back. The cost of debt. So we were told that the current market cost before tax is 6%. They say it is before tax. It is not post-tax, right? It is not post-tax. It is what? It is pre-tax. It means that there will be a tax relief. Don't forget, for every debt, right, there will be a what? A tax relief, a tax shade, right, on it, because the relevant tax authority, that is why some companies, don't forget that we have what we call the method of finance. What are the method of finance? Who can tell me what are the method of finance? If I want to finance a business, I can use different three methods. What are the methods? I can decide to use one method. If I don't want to use one method, I can use the second method. If I don't want to use the second method, I can use the third method. What are the the method of finance. You can tell me what are the method? Okay.
Equity, debt, preference share.
They are we are not talking about the sources of finance, right? We talk about the method of finance. If I want to finance the business, I can decide that I want to go by this, I want to go by this. There is a law there, right? There is what we call pecking order theory. What does this say? The pecking order theory says that
Retain
if
learning.
if I can decide to the sources of finance is being arranged in what? In preference, right? I can decide that I want to go by equity, because don't forget, equity, I can decide that, okay, the first thing I will go for is retained earning, right? I will check the retained earning that I have, will it be enough to embark? Will it be enough to finance this project? Method of finance, method of finance. Will it be enough? That is pecking order theory. You look at it first from retained earning. Retained earning. Oh, with this retained earning, after you remove your dividend and all that, right? What you have, retained earning, right? You look at it. Will it be enough? Bed in hand. No. No. That one is other dividend policy. Will it be enough for you to finance the business? So when you look at that, you can now switch that, oh, retained earning will not be enough. Okay, go by debt. You switch to debt because the cost of debt is lower. Is that not so? You want to finance it internally, but you look at it that the retained earning will not be enough to finance the business. Then you look at it, okay, let's go by debt, right? And when you do the analysis, you see that, okay, the cost of debt is cheaper than equity. Then when you look at it that, oh, debt is not enough to finance the business, then before you now go by what? Equity. Don't forget, the cost of equity is usually higher, right? That is what we call pecking order theory. Pecking order theory says that your method of finance is being arranged according to their what? Their preference, right? According to what? Preference. There is another one called static order theory, right? Please go and read up all those method of finance, because the question you may be told that, oh, what are the method of finance? You now add the method of finance to the sources of finance. Can you see it? Method of finance and the sources of what? Finance. So what I'm saying here is that in essence is that the cost of debt is usually lower, right? Because of the tax part of it, right? Now, in this case now, we have about 6%, right? 6%. So we need to reduce it. 1 minus, what is the tax given to us? What is the tax given to us in this question? What is the tax?
30%.
30%.
Okay, 30%. Okay, that's fine. Now they're active this night to try. They give me joy. And so what do you have? What do you have? What do you have? Quickly, what is the cost of debt? What is the cost of debt? Quickly.
4.2%.
4.2%. So 4.2% or 0.042, right? 0.042, right? Am I right? Am I correct?
Yes.
0.042. Or this one is 0.01226, right? 1226. Now, if this is established,
0.126.
oh, 0.126.
26.
Okay, that's fine.
Okay,
Thank you.
that's fine. Thank you.
So in this case now, we can now plot our weighted average cost of capital, right? The weighted average cost of capital, whether we must complete this question today. So the VE, the value of equity, is 70. The cost of equity, what is cost of equity? 0.0126.
That's 0.1226, not 0.0126. Remove the zero.
Okay, like this.
Okay, like this.
Yes.
Thank you. So this is value of equity, all right? The value of equity is 70 plus the value of debt. The value of debt is 30. Please mute your mic. Please mute your mic if you are not talking. Just mute your mic, please. Please. 70 plus, I need the final figure, please. I just need final figure. What is the value of debt? The value of debt is 30, while the cost of debt pre-tax, post-tax is 0.042. So I will remove this. So please, I need final figure. What is the weighted average cost of capital of PACO that we will use to discount it? I just need final figure.
9.84.
Okay. 84%. Okay. Now, please, others should confirm this figure, right? Now, if this is established, what next? So we can now, what next? The next thing is to tabulate, right? Free cash flow. Okay. So free cash flow, PACO. So please, presentation matters a lot, please. Free cash flow to the firm for 4 years, right? So free cash flow to the firm for 4 years. So we can have year 1. So you can have this year 1, then year 2, year 3, then year 4. Okay, let's just put this. I think it's in thousands. Let me check. Is it in thousand? Okay, 1,000. That's fine. So if you have question, I'll mute your mic quickly before I move out from this part.
Sorry, sir. My question is in a examination hall, can someone start with workings before jumping to the solution? Is there any penalty to that?
There's no penalty or anyhow that is convenient for you. Just use anything that is that will be convenient for you to get. So that is why
Okay.
it's very important for you to practice questions so that you know that okay, this is what you want to do. That is planning, right? That is what you want to do. Any other question? Please. Okay.
Yes, sir. I'm sorry, sir, for taking you back. Please, that gearing equals to equity over equity, something. Please, how did they get it?
Which one? Okay. This is everything is equals to 30, right? Check the question. The gearing everything is equals to what? 30. Is that not so? So if everything is equals to 30, right, your debt will be 30. This debt here, the denominator, right, 30. Why this will be 40? Will be 70. So the denominator will be total, the total will be 100. Do you understand? So this is where we pick the 30. It's given to us. It means that all this will be equals to what? 30. Right? So what it indicates is that 30 is for debt, then 30 is for debt plus equity, which is 70. Then I will advise you to go back to and check our previous lecture on risk-adjusted cost of capital so that you have more understanding of this. Thank you. So
So I have a
this is
question. Sorry.
who is that? Sorry. Okay,
Sorry.
go ahead.
Okay. You're using the, should I say parent company? No, it's not the parent. Like the acquirer, the indices for the acquirer. So, so how do we know that we are to use the ones for acquire? Because there was a question I was trying to do 2023. It was the one of the other company, like the ungeared company, something like that. Because that question was more of mergers and acquisition, also to gear and ungear too. So
Chimobi, have you been following our classes? Like, have you been following our lectures? Like, have you been following consistently? Like, you've been consistent with lecture.
I've been attending, but I didn't attend this.
Thank you. See, we have never, any day, anytime we want to solve question. What is the first thing we normally do? The first thing we normally do is to read the required and understand the required first. When you don't understand the required, you miss everything up. You understand, or your understanding of the required, it is assumed that you have solved 70% of the question. And what is the required? The required says calculate the free cash flow for each of the firm using what? The free cash flow to the firm and the combined company, right? And the combined company. So you calculate the free cash flow for each of the firm. Then we will now combine them. Then we look at it. Is there synergy or not? That is what we use to advise. Right? So please, it is not all about. I usually say, even in performance management class, it is, you cannot just see question because it is free cash flow, because it is variance, or it is merger. Yes, I know it. No, understand the required. Flip through all the required. Understand it. Then you will not start from the one you know that you can do within 30 minutes. Right? Last question, please, before I continue. Next.
Okay.
Okay.
April, good evening. Please, I just want to be cleared on something. This work that we calculated for, I understood the formula. You know, value of equity is 70%, oh, the value of the 30%, but we just wrote 70/30. We didn't convert it, but we converted the other ones.
Which one did you
Why?
convert? Well, see, well, I don't, see, you have been following me, right? You should know that when I do something like this, I'm just looking for a way that something that would be so very easy for you to do. When we want to do the cost of equity, I didn't even convert. I just say 4%. If you convert it to 4%, if you convert 4%, right? At the end, your final answer, you will need to multiply it by 100. So just use figure and move on, so that you will not stress yourself. Oh, you need to convert it, you need to do this, you need to. There is no. I can decide to convert everything. I will still arrive at the same answer. The only thing is that at the final answer, I will need to multiply by 100 so that I will get percentage. Do you get that?
Yes, no, I understood the cost of equity that we calculated for. That one is very clear. I'm talking about the work.
That is
You
still
look
the
at in
same
the
thing.
work,
It's
like this
still
70 now, we wrote 70, we didn't convert. If we
don't
convert it, are we going to get the same answer? That's
go and
just my
just go see, that will be your assignment. Go and convert it. Then you see if you will get the same answer or not. Right? But converting it, it will waste your time. like you're supposed to spend like 5 minutes or 2 minutes or 3 minutes for work. You end up spending 10 minutes, which that 10 minutes, that additional 7 minutes can be allotted to another question, right? So next thing, please, let's quickly move on, please. So the next thing is, so we need to get our free cash flow, right? Can you see in this question, right, that we cannot use the profit after tax given to us? Why? Because this is just for 1 year. But we were told that you can see it is not even stated that it is for 5 years, it is for 4 years. But from the growth rate, we can ascertain that it is for 4 years, the next 4 years, right? In some question, it will be stated that, okay, 2022 to 2023, 2024 for next 5 years, right? But in this question, it is a very big trap, right? Check examiner comments. Now, so which means that, don't forget, the sales will increase by 5% for the next 4 years. For the next 4 years. So you have to increase the sales by 5%. So now, we move on to this. We need to increase the sales. What is the sales given to us in the question? The sales given to us in the question, 13,333 times 1.05. So what do you have here?
$14,000.
Okay.
Okay.
Esther.
Esther
Yes, sir.
And
and
Rachel.
Rachel.
Exclusive. Just be at the
Exclusive. Just be
background.
at the background.
Please, the three of you
Please,
will be
the
giving
three
me
of you will be
figures.
giving me
Please.
figures, please.
Others should
Others should
mute their mic,
mute
please.
their mic, please.
Thank you.
Thank you.
Okay. This is 14,000. Then, what do we have
Then,
here?
what do we have here?
14,700. 15,435. 16,207.
Okay. Now, we need to determine the profit after tax. Then we will now start the free cash flow, right? Now, from the question given to us, we need to go back, right? We need to do what? We need to go back. What is the operating cost? The operating cost is this, right? This is the operating cost, right? Ideally, we were supposed to grow this operating cost by 5%, but there is a clause here. What is the clause? That operating cost include depreciation. Gifted, you did not mute your mic. Gifted. Now, we were told that ideally we were supposed to increase this operating cost by this 5%. But because the clause says that expected annual growth rate in sales and operating costs, including depreciation. So which means that when you want to grow the operating cost, you have to add depreciation. Then you cannot increase it, including. Don't forget that they actually separate the tax allowable depreciation. Can you see it? So when you want to grow it, you have to do what? You add both your operating costs and your depreciation together. Then you cannot do what? You cannot charge the 5% on it. So the operating cost is 8683, while the depreciation is 1450. So we grow it. So therefore, we can have operating cost, operating costs include DEP, right? Depreciation. Operating costs include depreciation. We can to adjust this line. Okay. So we need to grow it. Please favor when it is 5 minutes to end this class, right? Meeting. Just let me know so I can create another link. Thank you. So please, what is the operating cost? Figure for the operating cost. Then I need to add them together.
8683. 1450.
Okay. So this is what we want to grow, right? We grow it by 5%. So what do we have here?
Ten six four zero. 10640.
Okay. 10640. Next.
11172.
Okay. 11172. Next.
11731.
7 what? 31.
731. Yes, sir.
Next.
12318. Sorry, sir. This thing, I don't know. Can someone confirm these figures? This for the first year, I don't think it's correct, though. And if it's not correct, others are wrong too.
The figures are correct, but just
Nearest.
that third year should be 11,730. Then the last one should be 12,317. So that's what I.
Sure, you approximate now. She actually has
Yeah, she
approximated.
approximated, but
Okay, that's
I'm
fine.
using all the figures. Yeah.
Okay, are we good to go? Right, we move on. Right, we can move on to. So from the question, what do we have again? Quickly. Oh my God. So we will have profits before interest, right? Or operating profit. We can have operating profit. After the operating profit, what do we have after the operating profit? Then we can
Position.
now we can charge tax. Don't forget that interest is non-cash item, so you don't even need to put it unless if you want to do double work. If you want to do double work, you can subtract the interest, right? Then when you want to do your free cash flow, you subtract the interest, you charge your tax. Then when you want to do the free cash flow, you now go back and add the what? The interest. So it's just you are repeating the same thing. So just move on, just remove the interest, right? Get your operating profit, charge tax on it, and do what? You move on. Class, what is the operating profit? Operating profit.
We have 3360.
Okay, operating
Okay,
profit
operating profit
33.
33.
60.
Okay,
Okay.
3528.
next.
Next.
3704. 04. 3890.
Tax.
Tax.
1008.
Okay, no problem. Okay. How many percent? 30%, right? 30%. Okay, give me figure. Figure. Where is Rachel?
Okay.
The last
100.
one is 6%.
Next.
Next.
1058. 111. 1111.
Sorry, please. How did you get the operating profit
The last
from?
one is 681.
Please, if you
Please,
have
if you
question,
have question,
kindly make
kindly
use of
make
the
use
either
of
you make
either
use of
you
the
make use
chat
of the chat
button
button
or you
or you
indicate,
indicate,
please.
please.
I'm coming.
Um,
Next.
Next.
1167.
Profit after
Profit
tax.
after tax.
The first one is 2352. 2352. 2470. 470. 2593. And 2723.
Okay, that's a very good one. Zeno.
Don't worry, I've gotten it already.
Okay, that's fine. So the reason why I don't want us to like stress much on this, right? Because we already have the understanding from the free cash flow format, right? So ideally, I'm supposed to say less interest. If I say less interest, I will have profit before tax. I will charge tax. Is that not so? You have profit after tax. After I calculate my profit after tax, I will still go back and say add non-cash item. Then I will still add I will still add what? Interest. So there is no point, right? There is no point of doing that. Is that not so? So the best thing for you is that just have your operating profit, have your tax, your profit after tax. What's next after the profit after tax? Check the replacement cost given to us in the question, right? We're told that the replacement, there will be a replacement investment. Don't forget that the real cost of the replacement is 1,600, right? It is what? 1,000, it is 1,000 1,600. And we're told that the replacement investment will also be growth. There will be a growth rate in the what? In the replacement investment, right? And another thing is that including depreciation, another thing is that you should also be aware of is what is it called? Is your depreciation. Don't forget that in this your profit after tax, depreciation has actually been included. Is that not so? Depreciation. Don't forget that you've actually, okay, 5 minutes. Okay. Don't forget that you've added depreciation here. Is that not so? You've add depreciation, which is 1,450. So the first thing you need to do is that you add depreciation, right? So when you want to add the depreciation, don't forget that you grow the depreciation here with the operating cost class. You grow the operating cost and the depreciation here. So in this case, you can now separate the part of depreciation. You will grow the depreciation by 5%. And don't forget, in this part, we were told that including depreciation, there will be a growth rate in what? In depreciation. Including depreciation by what? 5%. Right? So now you have depreciation. You already added depreciation here. Is that not so? You add back your depreciation. And the depreciation figure is what? 1,450. We cannot copy all these things here and put here because operating cost is inclusive. So how do we separate it? So it's just for us to say, okay, what is the cost of depreciation? The cost of depreciation is even 1,450. Now, if the cost of the depreciation is 1,450 as value, then increase it by what? 1.05. So when you increase it by 1.05, you will see you have to add it back because it has been included in this operating cost. Class, am I communicating? So am I communicating, class? Okay. Now,
Yes, sir.
okay. Now, I need to create another link so that we can continue our lecture. Thank you.